So this week, the corporate calendar for the uranium sector looks, well, it looks like an absolute ghost town.
Yeah, completely empty.
Right. I mean, if you were just glancing at the scheduled press releases, you'd think the market was taking a vacation. But behind the scenes, it is a completely different story.
Oh, absolutely.
You've got Western superpowers quietly buying up the world's most lucrative mines. Millions of pounds of African supply are, like, legally paralyzed by an international tribunal.
Right, the ICSID injunction.
Yeah, exactly. And the future of artificial intelligence in India is somehow hinging on a decades-old mining ban in the Australian outback. So welcome to today's deep dive.
It's the perfect example of why you can never just look at the surface, you know? The quietest weeks on the calendar are often the ones where the tectonic plates of the market are shifting the most.
Yeah. And our mission today is built specifically for you, the new investor. We're going to help you navigate this upcoming week in the uranium market. So that's June 15th through June 19th, 2026.
Which is going to be a fascinating week.
It really is. Because stepping into the uranium market for the first time, it's kind of a shock to the system. You expect it to be pure math, right? Supply goes down, demand goes up, price reacts.
Right, but it's not physics.
Exactly. It's not physics. It's more like meteorology mixed with psychology.
Yeah.
You're trying to predict global geopolitical weather while guessing how panicked the crowd is going to be when the rain starts.
That tension is really the defining characteristic of this asset class. You have the raw mathematics of a physical deficit, sure, but it's completely wrapped in human emotion and passive computer algorithms and international politics.
Yeah, it's a maze. So to guide us through this maze, today's analysis is powered by the Uranium Unleashed, the Geopolitical Risk Premium and Market Outlook newsletter, along with their highly detailed internal briefings.
Which are excellent, by the way.
They really are. Now, before we start unpacking the mechanics of this week, we have to lay down the mandatory ground rules. This deep dive is absolutely not financial advice. It is strictly for educational and informational purposes. You must always conduct your own due diligence before making any investment decision.
Always do your own research, yeah.
And if you're serious about understanding the intricacies of this space, we strongly encourage you to subscribe to the Uranium Unleashed podcast for their ongoing day-to-day coverage.
Yeah, their briefings provide the exact kind of granular data you need to parse out what's actually driving the tape on any given day.
Okay, let's unpack this. We're looking at a week defined by one massive overarching theme. It's this tug of war between the geopolitical risk premium, which is really just a fancy way of saying market fear, and the raw physical supply and demand fundamentals of the metal itself.
Right.
So we need to start with the biggest, most immediate catalyst looming over the Monday market open, the geopolitical elephant in the room, the Islamabad Declaration.
Yeah, this is huge.
Can you walk us through what actually happened late Friday?
Sure. So late Friday, negotiators from the U.S. and Iran actually reached an agreement on the final text of the Islamabad Declaration. Now, it's crucial to understand that right now, this is just agreed text. It has not been operationalized yet.
Right. Nobody's signed the final execution order.
Exactly. But the details inside that text are profound. It lays out a highly specific 30-day window to demine and reopen the Strait of Hormuz.
Which is a massive global bottleneck. I mean, something like a fifth of all seaborne oil flows through there, right?
Close to 20%, yeah. It's massive. And alongside that 30-day maritime window, there's a 60-day window specifically dedicated to negotiating the status of Tehran's enriched uranium stockpile.
Wow, okay.
Yeah, they're sitting on roughly 440 kilograms of enriched material. So this document essentially attempts to de-escalate two of the most volatile energy choke points in the world simultaneously.
Let me try to translate this geopolitical risk premium concept for a new investor trying to wrap their head around why, uranium prices care about oil lanes.
Sure.
Is it basically like paying a massive premium for a backup generator because there's a Category 5 hurricane sitting offshore?
That's a great way to look at it.
Right? Like everyone in town is terrified the power grid will collapse, so the price of the generator skyrockets. Buyers don't even care what it costs. They just need the security.
Exactly.
But now, over the weekend, the meteorologists release a new model saying the hurricane might be downgrading to a tropical storm. The threat is still there, but the absolute worst-case scenario is fading.
That analogy captures the psychology perfectly, honestly. The physical uranium is your generator, and the looming threat of Middle Eastern conflict is the hurricane.
Right.
For months, utility companies and financial players have been buying uranium with this hidden tax baked into the price. They were paying extra because they feared a total breakdown in global energy supply chains.
Because an oil shock inevitably spills over into a panic for nuclear fuel security.
Exactly. But here's where it gets tricky for Monday.
Well, yeah, and here is where I want to push back a bit. I'm looking at my screen on Monday morning. The deal is literally just text agreed. Nobody has even started clearing a single naval mine out of the Strait of Hormuz yet. Not a single pound of that 440-kilogram stockpile in Tehran has been moved.
Nope, nothing physically has happened.
So why on earth does the market care today? Like, why would the price of uranium stocks react before any actual physical steps are taken?
What's fascinating here is how ruthless the market is at separating a fear bid from a fundamental bid. You have to remember, financial markets are entirely forward-looking mechanisms.
Right, they price in the future.
Exactly. They do not wait for the hurricane to hit the beach, and they do not wait for the sun to come out. They react the very second the forecast changes probability.
So just the rumor of the text changes things.
Right. Now that a framework is signed, even if it's just a piece of paper on a desk in Islamabad right now, the immediate existential panic begins to evaporate. The market realizes the worst-case supply chain disruption is less likely to happen today than it was on Friday.
So that built-in hidden tax, that fear bid, it just deflates.
It deflates rapidly. I mean, if the strait actually starts opening smoothly over the next week and the demining vessels get to work, that risk premium washes out of the market entirely.
Wow.
Yeah, and in the near term, that is structurally bearish for spot uranium prices. Without the fear, buyers just aren't willing to pay that panic premium.
But what if it falls apart?
Well, that's the flip side, and it's equally violent. If Tehran stalls or if a demining vessel hits a snag, that premium snaps back into the price instantly. The market will basically reprice the hurricane hitting the coast.
So as a new investor, you need actionable metrics. You need to know how to measure this tug of war on your screen.
You do.
What are the specific numbers from the Uranium Unleashed briefing that we should be watching this week to see if this fear bid is deflating?
You want to start by anchoring yourself to the physical spot price of the metal. Spot closed last Friday in a range of $85.35 to $86.10 per pound.
Okay, 85 to 86, basically.
Right. That's the physical reality. The test this week is to see if the uranium mining equities, the actual stock prices of the companies, decouple from that physical metal price.
Meaning the stocks drop even though the physical metal holds its value?
Precisely. If the equities sell off because traders are shedding the geopolitical risk, but the physical buyers are still holding the line at 85 or 86 cents, it tells you a lot about the underlying strength of the market.
Okay, so what specific tickers are we watching?
The specific equity to watch is Cameco, ticker CCJ. It closed Friday at $100.96. The internal briefing specifically highlights watching if Cameco can hold that critical $100 psychological line.
That's a big level.
It is.
Yeah.
You also need to monitor the broad sector ETFs. Watch URNM, which closed at $54.45, and URA, which closed at $45.52. Those are basically your barometers for institutional sentiment.
Okay, so if this geopolitical fear bid completely evaporates and those equities dip, a new investor might panic.
Oh, for sure.
They might look at their portfolio and think, well, the whole uranium investment thesis was just a mirage based on a conflict in the Middle East.
Right, which is a mistake.
But that leads us directly to the bedrock of this market. If we strip away the geopolitical weather, what does the actual supply of physical metal look like right now?
This is the important part.
Yeah, because we need to shift from abstract treaties to the very concrete reality of massive industrial mining.
Taking the fear out of the market actually does investors a favor, honestly, because it reveals just how constrained the physical reality of the metal truly is.
Like taking the tide out to see the rock.
Exactly. The geopolitical risk premium is just noise. The structural physical supply deficit is the signal.
Let's look at the massive signal that just dropped on Friday regarding the Cigar Lake mine. For context, Cigar Lake in Canada is what the industry calls a Tier 1 asset.
Right. And to define that for a new investor, a Tier 1 asset isn't just a good mine. It means it is one of the absolute largest, highest grade, and most profitable operations on the entire planet.
It's the crown jewel.
It is the crown jewel of global uranium.
And TEPCO, the massive Japanese utility company, just announced they sold their 5% stake in Cigar Lake.
Yep.
Cameco swooped in and bought a portion of that stake for roughly 115.75 million Canadian dollars.
Big move.
Huge. That bumps Cameco's total ownership to 57.418%. And the French company, Orano, holds the rest at 42.582%.
Right.
So how does a new investor interpret a Japanese utility selling a stake in a Canadian mine to a North American major? Like, what is the underlying mechanism there?
The mechanism is the aggressive consolidation of Western supply. TEPCO has its own domestic complexities in Japan regarding their nuclear restarts, which often forces capital allocation decisions.
They need the cash elsewhere.
Exactly. But the story here is who bought it. By sweeping up that 5%, Western majors Cameco and Orano now own a full 100% of the highest grade operating uranium mine in the world.
Wow, 100%.
100%. It's a clean, highly strategic move that permanently locks up top-tier supply exclusively for North American and European energy grids.
And right alongside that buyout, you have the NexGen Rook I project, also in Canada. This is the largest Western greenfield project currently on the board.
Right. Greenfield being the key word.
Which means they aren't expanding an old mine, right? They are starting from absolute scratch on an empty plot of land, building massive infrastructure from the ground up.
Exactly.
And they received their site preparation and construction license from the Canadian Nuclear Safety Commission, the CNSC, back on March 5th.
And getting a greenfield license from the CNSC is arguably one of the most rigorous regulatory hurdles in the global mining industry.
It takes forever.
Decades sometimes. The fact that they have it in hand is a monumental de-risking event.
And now they have 300 million Canadian dollars in initial spending teed up. The market is basically sitting on its hands waiting for the official signal that excavators are moving dirt.
Just waiting for the green light.
So in Canada, you have $100 million corporate buyouts closing on a Friday and massive new projects greenlit to start. But then you look across the world to the African continent, and the supply situation is wildly bifurcated.
Oh, complete.
It is a completely different reality.
So contrast between the Canadian basin and the African continent right now is the perfect illustration of why physical supply chains are so fragile.
Let's break down that contrast. On one hand, you have Lotus Resources down in Malawi. They are successfully ramping up their Kalakara mine.
Right. They're doing great.
They are hitting what the industry calls nameplate capacity, meaning the theoretical maximum output the facility was engineered to produce. For them, that is roughly 200,000 pounds a month, and that material is beautifully integrated into Western supply chains.
Seamlessly.
But then you move just slightly northwest to Niger, and you hit a brick wall.
A legal brick wall, which is often harder to move than a physical one.
Exactly. In Niger, you have the Somagar stockpile. There are between 1,300 and 1,800 tons of fully processed uranium just sitting in the desert.
It's just sitting there.
We are talking about roughly 250 million euros worth of metal. But it cannot move. It is completely legally paralyzed by a September 2025 ICSID injunction against Orano.
And to clarify what that means for the listener, ICSID is the International Center for Settlement of Investment Disputes.
Okay.
Think of them as the ultimate global referee for standoffs between sovereign governments and multinational corporations.
Right.
When relations deteriorate between the local government in Niger and the French mining company Orano, ICSID steps in. An injunction means that metal is legally frozen. It cannot be exported, it cannot be sold, it cannot be touched until the arbitration is resolved.
Which takes years.
Oh, easily.
So how should a new investor weigh these two completely opposite realities? You have smooth, rapid corporate efficiency in Canada, paired with multi-year, slow-moving international legal nightmares in Africa.
You weigh it by looking at the net impact on the global utilities that actually need to burn this fuel. The Canadian buyout and the NexGen project are incredibly bullish, but NexGen is going to take years of construction to pour its first pound of yellowcake.
Right. It doesn't solve today's problem.
It doesn't help a power plant today. Meanwhile, that frozen stockpile in Niger is supply that European utilities had modeled into their near-term forecasts.
I thought they had it.
They assumed they would have access to those 1,800 tons right now. When an international tribunal takes hundreds of millions of dollars of expected supply off the market indefinitely, the mechanical shortage of the metal intensifies immediately.
Wow.
The geopolitical fear bid over Iran could drop to zero tomorrow, but the reality of those frozen tons in Niger remains. That physical constraint is the bedrock that keeps the long-term bullish thesis intact.
Okay, so transitioning from the physical constraints of mining in the dirt, we need to look at the digital plumbing of the stock market itself. Because we have talked about global treaties, and we've talked about international tribunals locking up supply.
Right. But for a new investor looking at their brokerage account this week, there is a completely mindless, mechanical event happening that is going to move stock prices violently, completely divorced from any fundamental news.
This raises an important question, right? Because this is where market structure steps in and temporarily overpowers the physical reality of the metal.
Exactly. I'm talking about Friday afternoon, June 19th. After the market closes, we have the semi-annual reconstitution of the VettaFi Global Uranium Miners Index.
Big day.
For those who've been around a while, this is the index formerly known as SPROT-URNM. Let me pause and ask this on behalf of a new investor. Are you telling me that a stock like Lotus Resources could suddenly swing 5 to 10% on a random Friday afternoon with zero actual news coming out of the company just because a computer algorithm demands it?
That is exactly what I'm saying.
Is this a trap I need to avoid, or is this a feature of modern markets?
It is entirely a feature of modern passive investing. To understand what's going to happen on Friday, you have to differentiate between a fundamental event and a mechanical event.
Okay.
A fundamental event changes the intrinsic value of a company. If a mine floods, or if a new supply contract is signed at higher prices, the value of the business changes.
Makes sense.
This index reconstitution is a purely mechanical event.
Because passive ETFs are essentially blind robots.
That is a highly accurate way to describe them. An ETF like URNM does not have a human manager deciding which stocks are good or bad today. It is a blind robot that mathematically tracks a published index.
Just following rules.
Right. Twice a year, the creators of that index update the rules. They look at market caps, trading volumes, and production statuses, and they recalculate the weightings. They might decide that a newly producing developer like Lotus Resources now deserves a 3% weight in the index instead of a 1% weight.
And the blind ETF robot is forced to comply. Immediately. Because massive amounts of passive money are housed in these ETFs, when the index tells the robot to increase its weighting, the robot mathematically has to go into the open market on Friday afternoon and aggressively buy millions of dollars of that specific smaller cap stock to balance its ledger before the closing bell.
So if you see a wild price spike in a mid-tier mining stock on Friday at 3:55 p.m., do not panic and do not suffer from FOMO thinking you missed some massive breaking news on Twitter.
Right, ignore it.
It is just the digital plumbing of the stock market, forcing capital through a narrow pipe. For the 10-year investment thesis of nuclear energy, this event means absolutely nothing.
Nothing at all.
But for the near-term tape, the actual price action flashing green and red on your screen, it is a massive flow catalyst.
Which is why understanding market mechanics gives you an edge. You don't get shaken out of a position by a temporary algorithmic distortion.
Exactly.
And speaking of understanding market mechanics, if we look just slightly past this mechanical Friday, we also need to put Kazatomprom on our radar for the following Monday.
Oh, right. Kazatomprom is the state-owned enterprise in Kazakhstan. They are the single largest uranium producer in the world.
The absolute giant in the room.
And they have an extraordinary general meeting scheduled for June 22nd. Now, technically, the filings say this is just a routine governance event to re-elect their board of directors. But the Uranium Unleashed briefing flags this as a potential volatility event.
It definitely is.
Why does a dry corporate governance meeting in Kazakhstan matter to a retail investor in North America?
Because Kazatomprom is the Saudi Arabia of the uranium market. They control a dominant percentage of global output. When you have an extraordinary general meeting regarding the board, you are dealing with the people who set the production quotas.
The people who hold the keys.
Exactly. The briefing notes that while it's technically about governance, it's highly likely that leadership will drop hints or guidance regarding their 2026 production output targets.
Oh.
If they hint that they're struggling with, say, sulfuric acid shortages and might miss their 2026 targets, the entire global supply model has to be recalculated.
Every word spoken at that meeting will be parsed by analysts.
Down to the syllable.
So we have covered the tight physical supply in the ground, and we've covered the mechanical index robots shuffling money around. But what is the ceiling for all of this?
That's the real question.
If supply is so constrained, where is the explosive long-term demand coming from that justifies the institutional capital pouring into this space? Here is where it gets really interesting.
Oh, absolutely.
Because we are moving entirely away from legacy 1970s power grids and stepping right into the bleeding edge of the 21st century.
This is the narrative shift that completely transforms how Wall Street views the periodic table element of uranium.
Let's look at the two wildcards looming over the market right now. First, the U.S. Nuclear Regulatory Commission, the NRC, has a deadline approaching in H1 2026.
Meaning the first half of the year, anytime between January and the end of June.
Right. The NRC is set to issue a construction permit for TerraPower's Natrium project. If this permit goes through, It would be the first commercial small modular reactor and SMR approval in the history of the United States.
Which is historic.
And concurrently, halfway across the globe in Australia, there is this massive, intensifying lobbying effort to lift their decades-old federal ban on uranium mining. But the reason they want to lift the ban is what blows my mind.
It's wild.
They aren't trying to dig up uranium to turn the lights on in Sydney. Lobbying is specifically aimed at exporting the fuel to power dedicated artificial intelligence data centers in India.
The convergence of those two storylines is just profound. To ground this for the listener, an SMR, or small modular reactor, is a next-generation nuclear plant. Instead of building a massive, custom $10 billion facility over 15 years, SMRs are designed to be manufactured in factories.
Like on an assembly line.
Exactly. Shipped on trucks and assembled on-site to provide localized power.
Uranium is no longer just a story about keeping the lights on in traditional cities. For a new investor, you have to internalize that uranium is rapidly becoming an artificial intelligence infrastructure play.
It really is.
AI data centers require an unfathomable amount of electricity to train their models. The big tech companies have suddenly realized that you cannot run a 247 multi-gigawatt data center on wind turbines when the wind stops blowing, or solar panels when it gets dark.
You just can't.
They need incredibly dense, reliable baseload power that does not emit carbon.
The demand curve for electricity from the tech sector is going vertical, and nuclear is really the only physical solution that meets all their requirements.
Yep.
However, we do need to pull this back to the actionable week ahead. The TerraPower NRC permit is a colossal milestone, but the probability of that specific press release dropping this exact week is quite low.
Yeah, unfortunately.
Regulatory agencies in Washington do not coordinate their announcements with our trading calendars.
They certainly don't care about our Friday afternoon ETF rebalance.
They really do not. But because we are deep into that H1 2026 deadline window, it is a high-impact item you must watch daily.
Keep it on your radar.
If that permit hits, it validates the entire reactor build thesis. It proves to the broader financial markets that next-generation SMR nuclear isn't just a venture capital science experiment anymore.
It's real.
Right. It's a federally approved commercial reality. That singular event dramatically moves the long-dated demand narrative, which forces institutions to reprice the value of the metal today.
So, to synthesize this entire deep dive into an actionable playbook for you, the new investor, navigating the week of June 15th.
Right.
Number 1. Keep your eyes glued to the Strait of Hormuz and the fallout from the Islamabad Declaration.
Right.
If the demining starts smoothly and vessels move, expect the geopolitical fear bid to deflate, which might soften spot prices in the near term. Understand that mechanism.
Watch the physical decoupling.
Number 2. Watch the physical supply bedrock. Listen for any mobilization signals or capital deployments from NexGen's Rook. I project to validate that new Western supply is actually moving forward to counter the frozen African supply.
Very important.
And number 3, be deeply aware of the digital plumbing on Friday afternoon. When you see wild swings in smaller cap producing stocks, remember it is the mechanical URNM index robots executing mandatory rebalances, not breaking fundamental news.
That synthesis is the exact edge you need. The biggest advantage you can cultivate as an investor in a complex system like this is the ability to discern the why behind a price movement.
Knowing the difference.
Exactly. Knowing the difference between a stock moving because a passive computer algorithm is mathematically forced to buy it versus a price moving because global supply chains are fundamentally fracturing.
It all comes back to that opening concept. The market is not just physics. It is meteorology, it is human psychology, and it is the automated plumbing of the financial system all grinding together at once.
All at the same time.
And I want to leave you with one final provocative thought to mull over as you watch the market open this week. Think about that AI wildcard we just discussed.
Yeah, this is the big picture.
If the absolute bleeding edge of our technological future, the massive supercomputing AI data centers currently being planned in places like India, if their very existence relies on lobbying politicians to lift a decades-old ban on digging up dirt in the Australian outback, are we really just investing in a raw industrial metal? Or are we actually investing in the unglamorous, highly constrained, physical bottleneck of the entire 21st century digital economy?
That realization is what separates the tourists from the long-term investors in this sector.
Something to think about while you watch the geopolitical weather forecast this week. Thanks for joining us on this deep dive.